In our daily lives, we rely on precise tools to measure the world around us, using inches or pounds to give abstract distances a value. But measuring with value of money is different, because currencies are constantly moving in increments much smaller than a single penny. This is a typical digital exchange rate for the euro against the US dollar. It is carried out to 4 decimal places, currently sitting at 1.0850. Without a standardized system to track these tiny fluctuations, trading would rely on vague estimates rather than specific, repeatable calculations. To solve this, traders use the Pip. The name is an acronym for percentage in point. Think of the Pip as the inch or millimeter of the financial world. It is the standardized unit that makes up the vertical axis of a currency chart. On most major currency pairs, you will find this unit at the 4th decimal place. If the euro moves from 1.0850 to 1.0851, that shift represents a movement of exactly 1 pip. Learning to identify this digit provides the baseline you need to track how far the market has moved and what that means for your account. You might notice that many modern trading platforms actually display 5 decimal places, which can look confusing at first. This 5th digit is known as a pipette. It is simply a fractional pip, representing 1/10 of a full pip. Most traders find it helpful to focus on the larger 4th digit and treat the 5th digit as minor extra detail. Filtering out this extra digit keeps your math simple and helps prevent basic errors when calculating the value of a trade. Once you can count pips, you can determine exactly how chart movements translate into profit or loss. This is the basic math for every trade. Multiply the distance moved in pips by your chosen dollar value per pip. For example, a 20-pip move at $1 per pip equals $20 profit. Trading results aren't based on the total currency price, but on the distance the price travels and your chosen value per pip. However, there is one specific exception to the 4 decimal rule that every trader must know. While most pairs use the 4th decimal, pairs involving the Japanese yen work differently. For the yen, the pip is always the 2nd decimal place. A move from 150.25 to 150.26 is a 1 pip change. If you try to apply the 4 decimal rule to a yen pair, your calculations will be off by a factor of 100. Miscounting the pips on these specific pairs is a common reason new traders encounter unexpected results in their account balance. Pips are useful for more than just tracking profit. They are the primary tool for building your defense. This red dashed line is a stop loss. It is an instruction to close a trade automatically if the price reaches a certain point. Traders use pips to set this limit, deciding to exit a trade if the price moves 15 pips against you. By using pips to define this exit point, you can know exactly how much of your money is at stake before you even start the trade. Using pips also allows you to calculate what is called a risk-to-reward ratio. In this scenario, the trader accepts a risk of 15 pips for the opportunity to gain 30 pips. Because the potential reward is twice as large as the risk, the math supports the strategy, even if not every trade is successful. Relying on these clear ratios allows a trader to build a strategy based on consistent logic rather than luck. The pip is the foundational unit of the market. It allows you to calculate the scale of a trade, set your targets, and place your protections. While you cannot control where the market goes, you can use pips to measure your risk and manage your account with precision. For more straightforward financial education, subscribe to the Forex Alert.